Welcome to an engineering economics video in which we are going to look at chapter 7. This is chapter 7 in the textbook, where we are looking at rate of return analysis. So the past several chapters we have looked at different ways of analyzing a potential project to determine if it's a project we would want to undertake or not. We've looked at payback period, discounted payback period, present value analysis, annual equivalence analysis, and now we're looking at one more, rate of return analysis. So this type of analysis basically looks at the earnings that the project will create and compares it to the cost of the project, and then treats it as if that were an interest rate. It basically looks at the percentage of the return versus the investment, and essentially figures out what type of rate would that be comparable to. And so there are other terms that are used for this type of analysis. You might hear someone describe the yield of an investment, or the internal rate of return, or something like the marginal efficiency of capital. So what we're going to do now is we're going to look at 3 different examples that try to explain this idea of rate of return. And we're essentially looking at 3 different ways of defining or describing this concept. So the first definition is that the rate of return is equal to the interest earned on the unpaid balance of an amortized loan. So think of yourself as the bank that's going to loan money out. You're going to loan, let's say $10,000 to someone, and they're going to repay it in annual installments of $4,021. So you'll receive 3 of those payments. What is the rate of return of this investment? And so let's pull up Excel to demonstrate this. So Excel will calculate rate for us, and that's what we're wanting to find here, the rate of return. And when we use the rate function, it wants to know the number of periods, the payment, and the present or future value. So our number of periods is 3. The payment, or maybe I'll just abbreviate that, PMT. The payment is 4021. And the present value is, what was it, 10,000. So what is the rate of return on this investment? It's going to be equal to the rate function of number of periods 3, payments 4021, and we need to make these 2, the way Excel works, these need to be 2 different signs. The present value, if we're the bank, we're giving that money away at first, we're loaning it out, so that's negative, it's leaving us, and those payments are going to come back to us over the next 3 years. So we'll leave the payments as positive, make the present value negative, and calculate that rate. Looks like it's 10%. Let's add a few more zeros on there. Looks like it's 9.998%. So in the previous slide, we were able to calculate this rate using a simple function. But what we've done here is we've set up a little bit of a chart to explain in a little bit more detail what's going on. So I'll go ahead and do that here in real time. We'll set up this spreadsheet that will show us the year, the beginning balance, I'm going to wrap the text in this cell. I'm going to go to alignment, wrap text. Okay, return, payment, and ending balance. And again, let's wrap that text. Okay, so our years are going to be 0, 1, 2, and 3. Again, we're looking at this from the point of view of the banker, not the lender. So we're going to start at the end of year 0, or in other words, the beginning of year 1. We are going to loan out, we're going to give away that $10,000. Okay, so at the end of year 0, or the beginning of the next year, the beginning of the next year is equal to the end of the last year. So this is like December 31st, January 1. There's really no change. Okay. So the people that we loaned the money to, they owe us 10,000, and we already calculated here on this previous slide that we're getting about 10%, or 9.998%. So the return on our investment in this first year is going to be equal to, actually let me put the rate down here maybe. Rate 9.998%. Okay, and let's make this a little bit bigger. There we go. So the return that we receive is equal to this percentage of the balance. And it's a positive return. And let's lock in this B8 cell. I'll just lock in both the column and the row just to be doubly sure. Okay, so that's the return we're receiving on that. Now the payment that the lender or the lendee sent us is, I believe it was 4021. Yes, $4,021. No, I wanted to, there we go. So the ending balance, again, when you send in a check to pay off a loan, not all of it goes towards bringing down your balance. In fact, we have to take out the interest, and it's only what's left over then that actually brings down the balance. So the balance in the following year is going to equal the beginning balance minus the payment minus the return. And I need to be careful here about what I'm doing or saying here. The parentheses here are indicating negative signs. So we're out at $10,000, okay, and then we get this return and this payment. So I should really rewrite this formula as we are starting off with that negative $10,000 balance, and we're adding to it the payment minus the return. Okay, so we're starting to bring down that balance. It's the person who took out the loan is getting closer to paying it off. Okay, so I'm just going to copy this down. Actually, I'm just going to copy these all down now. Okay, so that comes down. Okay, I ended up with this $3 balance, and I thought, that's weird. Why did that happen? And I realized it was because Excel sometimes does this annoying thing. When you just have a number written in and you copy it down, it thinks you want to add 1 to it every time. I haven't quite figured out how to stop it from doing that. But in this case, I don't want it to do that. This should remain a constant thing. There we go. So we're only 2 cents off. That's just rounding error right there. That's all that is. So this is showing us where we started in terms of we're out of $10,000, but we get this return on our investment, plus we get the payments coming back to us, and then eventually that loan gets paid off. The balance comes down to 0. Let's move that out of the way. Go on to the next slide. To look at the next definition of rate of return, another way to look at the same scenario here. Another way we could describe a rate of return is the break-even interest rate, at which the net present worth of a project is equal to 0. So we're looking at the present value of all of the cash inflows minus the present value of all the cash outflows. It's whatever the rate is that is going to give us 0. It's the break-even point. So another way that we could say this is that the future worth at the end of the project will equal 0. And so if we bring back that spreadsheet here, this is kind of why I built this out to illustrate this fact. This rate, this 10% rate, is the rate that is going to bring this all down to 0. I know it says 2 cents here, but here, let's do this. Let me reduce the number of decimal places. Doesn't want to let me do that for all of them. Let's try just one column at a time. There we go. We'll do one column at a time. So this just rounds it to the nearest dollar. So it doesn't let those 2 cents distract us from the fact that the 10% rate is the rate that is going to lead this investment. And when we look at our returns and payments, eventually brings that down to 0. So at the end of the project, it's 0. Now what if we change this rate from 10% to 11%? We would still have a negative balance there. So that 11% is not our rate of return. What if it was less? What if it was 9? Okay, that would put us into positive territory. That's not the rate of return either. The rate of return is 10. Okay, so we can either calculate it using this rate function like we did here, or we can do this with either guess and check, sort of trial and error, or we could use Solver to do that for us. Let me do that real quick. I don't need to make it that big. Let's go to Data, Solver, and I want to set my objective of this cell right here to be a value of 0 by changing the variable in this cell, and solve it. And we can see we came up with our 10% rate of return, just like we did using this method. Let me, actually, it looks like I'm just about out of time here. So we'll continue this discussion in the next video.